What's going on, everyone? My name is Nicholas Merton here from DataDash, and today is September 18th of 2023. Well, folks, I hope you all are having a fantastic day wherever you are, because in today's video, we've got to spend some time to talk about the calm before the storm. I believe we're on the cusp of a major move here, not only in Bitcoin and altcoins, but the broader asset markets as a whole. A lot of macro uncertainty is finally coming up from beneath the surface, and I want to spend some time to discuss all of those different dominoes that could potentially cause a lot of pain in the economy. We've got a lot to dive into in today's video, so if you guys happen to enjoy the rambling, consider dropping a like. It's one of the greatest ways you can support the channel, and let's go ahead and kick things off. So I want to spend some time here to talk about the fact that even though Bitcoin over the past month has been practically neutral here, we've been sitting sideways for some time. Over the last couple of days, we have seen a little bit of a boost up, at least last week we did, from around those lows at 25K up towards 26K. Overall volatility has been relatively thin here for the past few months. I think we can all agree here that Bitcoin really hasn't made any monstrous moves since back in Q1 2023. And while the market may feel kind of quiet right now, again, as I mentioned here, I think we're on the calm before the storm. I believe that there is something brewing behind the scenes. We first need to dive here into the macro picture. We need to dive into equities. And trust me on this when I say that direction in equities and broader assets as a whole are going to have a direct impact on Bitcoin. We need not look further than the fact that most stocks bottomed out in October of 2022. And if we subtract the FTX event that happened in early November, since then, that's pretty much when Bitcoin and altcoins started to churn higher. Especially a lot of those gains came in January, when it was pretty clear many people in the short term that equities were going to get a bolster higher and that we were finding support on the 200 week. Well, while VTI here, the Vanguard Total Stock Market ETF, has been churning up since October and made some pretty sizable returns here, we're starting to face resistance near prior relative resistance in February and April of 2022. Nearly a year and a half later here, we are starting to see that we're setting a lower relative high than the one we set back in the summer of this year. And it's showcasing a clear trend here that a lot of this buildup in valuations may come crashing right back down when we realize the things that we thought were going to drive equities higher are not substantial narratives to really kick off a new bull market. That is the point we've been driving home for a long time, and I think we're going to do it better today than we ever have. First off, I want to spend some time again to show that this is not just a broad measure of the stock market. You even have the market leading indices like the NASDAQ, made up of the huge technology stocks, which have already made up a huge amount of the returns and recovery from those lows back in October. Well, after getting back above the 200-day and 200-week, we climbed up here into mid to late July and again faced resistance at that same range from February and March and April of 2022, and have since then set in a slightly relative lower level from where we were back in July. And if stocks don't start to show up to the plate here, if these big technology companies, and I'm more specifically talking about Apple and Microsoft, the FANG stocks, if they don't start showing up to the plate, then we got a really big problem here. And don't believe for a moment here that, as a lot of people made the argument, oh, these technology stocks will be the ones that go up and it's all going to be fine and dandy, that when they start to go down, other equities just start to rise up. Guys, these are the biggest technology companies. Their weight on the trend direction of stocks, considering that they make up well over 20 to 22% of the entire valuation of equity markets. Just 7 companies, right? 7 to 8 companies make up 20+% of the overall asset markets, or at least the overall equity markets as a whole. This is going to have a huge weight on other indices like the S&P 500, which is facing similar resistance and demonstrating similar patterns. And also the small caps here, which are the weakest of all right now. And they still look like they're ready. Even after all of this wave of optimism, the small caps look like they're ready to snap, because the small caps have a much greater bearing here with the overall trajectory of the economy and liquidity. They are much more dependent on a risk-on narrative, as there is a higher risk in these companies. And as you can see from March of 2020, while they got hit probably the hardest out of all the stock indices, they rose up the fastest here out of those lows. So again, we want to keep an eye here on the Russell 2000 because it gives us a real idea as to whether or not there's a risk-taking mentality in the market. And I think it's clear by now that as these stocks are practically flat since more than a year and a half here, pretty much back since April of 2022, We have barely been treading here along the 200-day and 200-week, and it looks like we're ready to snap. We've actually been calling for a long time for the Russell 2000 to, at a minimum, come back down into this similar range here. Another 34% correction from this point on, coming down here towards 1,200 points. A lot of people called us crazy. A lot of people said we were being too bearish. Well, time will tell here if we get that right. At a minimum here, I think we're going to get another retest here towards this descending line of new support that was prior resistance. But if that doesn't hold here, if we get a retest that range and there's a big enough domino falling, then that's going to likely put us in a scenario where we're going to be able to scoop up some small caps at a great discount versus those who have been buying up in this range with their liquidity. So I want to go ahead here from this point on. We've talked about the charts here, right? It's looking like the macro tailwinds are setting in. These indices are not doing very good right now, or at least comparative to the optimism of the last few months. What could be causing this? Well, the first thing we've got to talk about here is the rekindling of inflation. Now, people will give you all kinds of different perspectives from the recent CPI reading. And it's important to look at those month-to-month numbers here. But essentially speaking, the month-over-month increase, some people will tell you was in line with expectations. Some will say that some economists said it was more or less or whatever. At the end of the day, take a look at the annualized inflation number. We are up from around 3% to 3.7%. Now, if the Fed is really doing its job, if the Fed is really not kicking the can down the road and setting the tone straight, it would have been raising interest rates continuously by 25, 50 basis points, or more maturely, really setting the tone and saying there is a ton of excess liquidity in the system. We know this for a fact. 75 basis point hikes. In fact, maybe even doing a 100 basis point hike to set the tone that the Fed is going to shoot for a short-term recession. It's going to get the job done. It's going to bring inflation, crater it to potentially short-term deflation, and get it back to the 2% target, because the Fed needs to do that. Unfortunately, the Fed has started to pause and is going to wait for the tailwinds of economic data, or it's going to wait for the lagging impact of the Fed's monetary policy. All this BS talk is it's just music to the ears of Wall Street speculators. Not working class Americans, not working class individuals across the world who are struggling to pay for their groceries, who are struggling to keep up with their mortgage, who are struggling to pay for their rent or their automobile expenses, whatever it might be, or pay for the cost of gas more specifically. And what has happened here? Because of the Fed, unfortunately, doing 25 basis point hikes and then pausing, right? I'm sorry to be snarky about this, but this is a serious job that they need to do. Well, what's happened because of that? Well, because the base impact decreases of energy prices have waned down, and other economic metrics of inflation, various other sectors, whether they be food, other types of goods or services in the economy, and along with that as well, energy prices themselves have started to reinflate. Whereas many people thought that the job was done because inflation was dropping like a rock, we see here that inflation is doing exactly what it did back in the 70s. When the first wave of inflation came from 1965 to 1969, and we cratered back down into the early 70s, we saw inflation reinflate all the way from 2.8%, after a drop from 6%, mind you, a pretty significant single-digit value here, right? Cutting that inflation rate by more than half here, right? Coming down, cratering into the 200-week, and bouncing right back up over the next 2 years. And then after that, making the same mistake, coming down into the 1970s, in the mid-1970s, towards around 5% from a peak of 12.2%, going on towards 14.8%. We've seen this time and time again throughout history, and it showcases that, again, we need to zoom out and we need to look at those long-term moving averages, because if history is repeating itself, if we are seeing even not perhaps a repeat, but a certain rhyme to what happened back in the 70s, this is a huge problem. And I would say that a lot of people who would, go back and say in history, oh, Nick, the 70s were a different time. There was the oil embargo. There's all these different things that were different from this time around. Really? It's not different from the situation there is with BRICS right now, and the supposed many people in crypto, by the way, who believe in that narrative that it's going to disrupt trade. While I don't believe it's going to dethrone the dollar by any means, it's certainly showcasing that over the next 10 years we are deglobalizing. Nations are less trusting of one another. People are now in a more isolated, more distrusting manner when interacting with one another when it comes to trade deals, foreign trade relations. This isn't me just being negative, it's the reality of it. We're going through an economic shift, and that is going to have inflationary pressures here. And the Fed knows that. But unfortunately, they're not dealing with this demand in the short term. They're not dealing with it as they should. And inflation is coming back really since back here in June. We've seen the bounce come up through July and August. And I think we're going to see it continue here in the month of September. And why is that here? Well, it's because of a simple fact here. We didn't get supply and demand equilibrium like we needed to. We aren't there yet, guys. Take a look at crude oil here. It has been living proof of that since the summer, where so many people thought that the oil bull market was here and that the overall bull rally that was previously playing out back in 2021 and 2022, that was over. We said, watch the 200 week. We beated this like a dead horse, unfortunately. I hate that analogy, but we really just took this point home time and time again to watch the 200 week. And what do you know? Every single time we deviated below the 200 week, right? We didn't even get a close here on the weekly below the 200 week. Every time buyers came in and drove it up here. And we said, wait to see if one of two things happens. Either oil breaks through the 200 week and stays below there, or we break above the 200 day. And if we break above the 200 day, you are going to see oil back at 3 digits. And so far, we have climbed from $67, roughly $65, $67 a barrel, all the way up to $90 a barrel. And I bet many of you, if you haven't felt it yet, I bet many of you are already feeling it though. You're seeing it at the pump, you're seeing it at the grocery store, you're seeing the inflationary effects in the economy come back. And you're not seeing your wages keep up. It has to do with the excess money in the system. People, unfortunately, because of all the excess printing, got stupid rich off of all of the stimulus checks, off of all the printed money, and that is still having effects in the economy. And we need to get back to, again, making sure that either we can produce more goods in the economy, more supply, which is really difficult now, not only with the supply chain disruptions, but more specifically with, again, at the end of the day, us just simply not producing enough in order to meet to that demand. The spending and purchasing power in the economy is still too strong, right? And again, the longer we kick this down the road, kick the can down the road, this is only going to get worse. And it's not just oil. We also see this in niche commodities here, like uranium. Some of you may recall, as far back as 2018, even well before COVID, we talked about the reignition of the valuation of uranium. I've been covering this since the bottom in 2016, my personal investing journey. But here on the channel, we started in 2017. We later covered in 2018. We said that uranium is going to go through a decade-long acceleration here in order to meet the climate, CO2 emission reduction goals for many governments, that nuclear is going to be an essential technology to that. And along with that as well, as we went towards the inflationary wave of commodities, that it just grew even stronger as an investment thesis. And take a look here. Uranium is at its highest level since the Fukushima incident in Japan back in 2011. Up here towards $66 a pound. Massive acceleration here from the lows. It's more than tripled from this range down here since we first talked about it. And that again was first covered here by the video we did, Uranium Fever, the next bull run in commodities. It was our prime commodity we focused on over 5 years ago. Now everyone's starting to talk about it. We've been covering it for a long period of time. And that's the kind of stuff, again, before we continue here through the video, guys, that's the kind of reporting you can get, not just here on this channel. We put out a lot of great free content here, but also in our newsletter, The Dash Report. We've got hundreds of members from the DataDash community, our most quality viewers and community members who are interacting within the Dash Report. We put out a 20-page report covering crypto, commodities, Forex, and the equities or stock market. We cover not only that, but we cover our market leader sectors, the sectors we believe are going to lead over the next couple years. I can tell you guys, if you're only dollar cost averaging into big tech plays or into crypto, I honestly think that's not diverse enough. And I think if you're looking to really outweigh the performance of the market, you can't be buying into these assets, which unfortunately are not at corrective territories yet. They aren't at valuations that make sense for long-term bets in order to weigh out the rest of the market. That's just my take personally. And if you've made it this far, if you guys appreciate the content, the opinion that I share here in the channel, although I don't always get things right, we try to do honest analysis here. We send out trade alerts. We just did our mid-month webinar. We had dozens of people joining into that. It was a really great time. But you can get all this stuff here within the Dash report, and you can get it 20% off if you sign up on an annualized basis. Just $240 for a year, less than a cup of coffee a day, less than $1 a day for that matter. And you can get a lot of really great offerings within the Dash report that really help you to get on top of the game when it comes towards investing and be able to hopefully beat out the market long term. But anyways, that's a way where you guys can support the channel as well. If you're looking for that and looking for that additional, I would say kind of 25% extra content, then that's definitely where you guys can get that with the Dash report. But I want to go ahead here and again continue the conversation. It's not just here when it comes to natural gas. It's not just the case for uranium or oil. It's also the case for natural gas here. We've been seeing a reignition here of natural gas prices since back in April. And while it's been relatively slow here in the grand scheme of things, we haven't seen any massive acceleration yet. We've seen natural gas essentially move close here towards the $3 value here on the contracts for difference. And from the lows, that's nearly a 50% increase here in natural gas. Now, while we haven't seen a major spark up yet, I gotta tell you guys, if we clear through this 3-point range, I think we're going all the way up here to 420 here, no pun intended, to fill in the gap in this range that was put back here in January. These are the kind of big moves that could start to come in here over the next couple of weeks and months. And it's not just me being negative, it's just the reality of it, guys. We already see the trend here in crude oil. We see it here in uranium, setting its highest level since 2011. I would not be surprised if you at least get a secondary wave here in natural gas, which moves much more volatile and much more aggressive to the upside and downside when commodities as a whole start making moves. And I understand to so many people out there who might be watching this channel, many of you who are kind of veterans on the channel, you get why we cover this, but some of you who are maybe watching for the first time might be like, all right, Nick, I trade cryptocurrencies. Why should I care about what's going on in natural gas? Because everything is interlinked to a degree. This isn't some kind of conspiracy here. If we essentially see commodities reigniting in their valuations, right, they become more expensive to buy, that is going to trickle down effects into every single good or service that you buy. And on top of that as well, it's going to make the cost of living more expensive, which takes away any potential disposable income that people use to speculate or invest in financial assets. And that's exactly why, as these commodities are starting to reignite, we're not only seeing equities start to correct, but on top of that, it's why Bitcoin is not able to clear through resistance levels like the 28 to 32K resistance range that used to be prior support. It is also why we're starting to see the red flip our momentum indicator, right? But there's also other things we got to think about, guys, because it's not so much that, there's just a weak investment case here for Bitcoin in a high interest rate environment, right? The Fed is going to have to eventually play catch up here. And it's likely going to mean that consumer spending on, investments, right, is going to be quite short for the next couple of months. That already alone is already enough to not really want to go long Bitcoin. It's the problem about what is going to break when the Fed has to tighten even more aggressively, when it needs to catch up and deal with inflation. And this leads me towards, I think, one of the biggest kind of red flags here we have at the moment here in equities. And that is REITs, real estate investment trusts. Now, you guys might have heard about REITs before. And to many people, some might ask, what's the problem with REITs, right? So REITs, real estate investment trusts, think of them as a ETF that you can purchase that baskets a whole range of either mortgages or, more specifically, various different rental or income generating properties. Sometimes it's a basket. Generally speaking, though, it's going to be based on some kind of portfolio of real estate, whether it be residential, commercial, that generally generates rent from its tenants and passes those as dividends on to the investors. Think of it as a one-click solution from your brokerage account to become a landlord, essentially. Now, a lot of people really like the idea of REITs here. This case, we're looking at Realty Income Corporation. It's a multi-billion-dollar company here, but $38 billion market cap at the moment, even considering the decline we've seen. And this has, again, generally been a pretty high dividend stock. It's paying 5.6%. But there's a couple different things here that are coming into fire here. First off, you've got bonds which are paying a pretty competitive yield that are risk-free. You don't have to worry about anything really beyond worrying that the US government is somehow going to default, right? Outside of that, though, you've got a much bigger risk here in REITs because these properties, their tenants, can, in many cases, not pay. And along with that as well, that can lead towards eventually REITs not being able to settle on the actual ownership of the property, right? Because there is debt underlying here. If you take a look at the balance sheet of these companies, these REITs, we can see that at the end of the day, they have liabilities. They may have assets, but they also have liabilities as well. So we need to keep that in mind here when we're talking about these companies. That's also why we see here, when we take a look at the stock price, that these REITs continue to move lower here. And we're pretty much at the same level we were at in March of 2020. If you adjust this to the debasement of the money supply, this is not looking good, right? Essentially speaking, these REITs are in a really rough spot, and they're likely going to get in an even rougher spot here over the next couple of months. The biggest reason for all of this is because as interest rates move higher, treasury yields will move higher, making them less attractive. But outside of that as well, in the fundamentals, you have people who may not be good on paying on their rent, as people are essentially getting laid off from their jobs, or companies are going under and no longer can pay their rental contracts. And these leave holes in REITs, just as it would be if you invest in normal real estate. And if you all know just how bad it's gotten on the Airbnb bubble side of things, and how that is going through a complete restructuring, and the residential suburban home bubble that built up over the past decade, similar back to 2008, we've got a lot of pain coming, guys. And again, it's why we've been emphasizing this point of stack cash. Don't stack sats right now in our opinion, like stack cash, pay down your debts, make sure you're in a good financial position so that if equities decline 20, 30, 40%, if the economy goes into a recession or worse off, a depression, that you're going to be positioned well, that you're going to be able to hedge yourself. And at the end of the day, if you want to hedge against inflation, there are tons of options for that. There is a high yield savings account, there is government treasuries, there's tons of different options that don't require you buy into something where its principal valuation may fluctuate rapidly here in the near term. That's the key thing we've got to be wary of here, guys. Now we can see for REIT, this is the Dow Jones Equity All REIT Index here. And you can see we've been holding below that 200 week. It's a clear sign here. And we've also got another company, Blackstone, not to be confused with BlackRock. Blackstone is essentially a huge player within the REIT market. And for the past year, they've basically had to freeze withdrawals on their REITs, which honestly, I don't think should be legal. But at the end of the day here, we can see while we've seen some short-term recovery here in the stock, we had the biggest volume week here, the biggest in the history of Blackstone. So I think something really fishy is going on here, and I think that the music is about to stop on a lot of these REITs. I think there's a lot of bad debt. There's a lot of real estate with the kind of long-term effects of working from home. This is going to undoubtedly have effects here for some big companies. And as these companies go through significant valuation contractions, it's going to hurt the overall investor sentiment here. It may not have a direct impact on crypto, but it will have ripple effects going forward. I think the airlines as well. Just take a look at the share price here, guys. Since 2018, airlines have just properly never recovered on the long-term time frames, so they're setting in lower highs constantly here. And we're pretty much right back where we were on March of 2020 for leading names like American Airlines. And you can take a look across the board at Southwest Airlines, you can look at Delta, you can look at so many others. Some may be stronger or weaker than others. The airlines are on a general long-term downtrend. And we can see, looking back at 2008, that these stocks can definitely move lower here. Even if they come back down towards their COVID lows, even if they come down here towards the earlier stages of the prior bull market in 2011, that is going to be wiping out more than a decade of acceleration and valuation. And that's going to set the tone here, I think, for many investors. I think the cruise liners as well, which are heavily dependent on consumer spending and consumers having disposable income where they don't need to cover their basic expenditures. I think a lot of these companies are going to go through bankruptcy and restructuring. Carnival's a $20 billion company. These aren't just small dominoes. When you add them up, they have a huge sizable impact to people's portfolios. And above all, guys, not only are these speculative stocks of GameStop, which are still well beyond where they should be in their fundamental valuation, sitting at a $5 billion valuation, 5.5 billion, even though they continue here to generally lose money and are seeing no acceleration in the revenue, and are only up here because of the Wall Street bets craze back in 2021 and 2020. Not only are all these stocks not safe, but I even think at the end of the day, comes back here to the topic. Apple is not safe. Apple here had an incredibly weak response, as we talked about here. And if a $2.7 trillion company, the largest in the world, followed by Microsoft, which is again another $2.5 trillion company, if they're seeing weakness now, if they are no longer market leaders, as we've been talking about for a year here during this relief rally, if they are no longer market leaders, we've got to find new leadership for a new bull market. And if we can't find them, if no one is showing up to the plate here and making sizable returns and getting investors juiced up, if AI as a narrative has fallen short, then we are in for a lot of catch up to the downside. And that is going to have an effect on Bitcoin here. That's why I don't care so much about the day-to-day moves, guys. I care much more about what's going on here fundamentally over the long term, both the near term over the next kind of 6-9 months, but also over the next couple of years. We got to start looking at those longer term timeframes. We can't get caught up in noise in the headlines. There's so many people out there who will lead you down towards that path to slaughter. I'm here to tell you guys what I believe to be the fundamental truths here, the fundamental reality of what we're facing here. It's easy to be disassociated from it if you're not being directly impacted by it 24/7. I know many of you out there are probably feeling it. You're feeling the inflation. You're feeling it with, worrying about whether or not, you've got that job secure for the next 5-10 years and stuff. The normal kind of questions that everyone should be asking at this point, even if you're not really at risk for it. Right? It's an important thing to be playing safe and make sure that you're not going to worry about your economic future. And I promise you guys, even if you maybe missed this relief rally, maybe if you're concerned about missing a future move in AI stocks like Nvidia, which already had a $1.1 trillion valuation, somewhere around that ballpark, I got to tell you guys, there's much greater risk going along these companies right now than any potential upside. Apple needs to double its stock value in order to reach this. It needs to go to $5 trillion in order to double its valuation. How is it going to do that in the next year or two? How is it going to do that over the next 5 years, for that matter, in an environment where liquidity is contracting? And how is Bitcoin going to smash new all-time highs? I know some people say that ETF, or they'll say de-dollarization, BRICS, or they'll say that the Bitcoin bank run. All those narratives have fallen flat. And we are one of the only channels here. There's some other great ones out there as well. I don't want to be a monolith of opinion, but we've been one of the few channels who've been preaching that point, that we're not ready yet. And it doesn't mean that things are absolutely going to collapse here today. It's not to say that the price for Bitcoin is going to do this. All right? That's not what we mean, right? When we say things are going to collapse, when we say things are going to start correcting, and that we have continuation of bear market activity when it comes to price action, it means that we're going to enter into a long but steady grind to the downside, where people's expectations that were previously optimistic will get blown out, and unfortunately made people get liquidated. They will lose that capital, and a lot of that excess money in the system that's still causing inflation is going to be washed out and taken out of the hands of everyday people. And we're going to go through a difficult period of time. That's just how it is, guys. It's how it is. The Fed has a job to do. A lot of people got stupid rich. The simple point I will make here to close things off here is that dumb money is easily lost. When you don't work for your money, when you don't work for your wealth, and you don't appreciate it, it's very easy to lose it to someone who will take it right from you. And think about that next time when you see someone promoting a Bybit referral link, telling you have to trade this move. It's not just traders on the other side, it's the exchanges. It's many content creators or promoters out there who don't have your better interest at heart, who don't respect your wealth and the time you've put into building it. Sorry for getting all heated here, guys, but this is important stuff. This is your future, and at the end of the day, you got to make those decisions. And I'm not here to say that you should just follow my opinion. Listen to a whole range of voices. Formulate your own opinions. But if you're looking for an in-depth report, if you're looking for something that can help give you that additional edge in the market, if you want to get access to the blue, red indicator we talk about here on the channel, guys, if you're looking for a different type of voice that can hopefully help you in your investment journey, you guys can check out the dashboard at the link down below in the description. And if not, if you guys just still want to support me here, definitely consider dropping a like. It's a great way to support the channel. And that'll be it for today's video, guys. I'll see you next Wednesday, or sorry, not next Wednesday, but this Wednesday at 6 a.m. Eastern Standard Time when our next video is uploaded. Take care, everyone, and I'll see you all in the next one.